In this session, we are going to discuss about derivative trading. You might have heard about futures, forwards, options, put option, call option, all those things, right? So I'm going to make it clear what you mean by derivative trading, and especially we talk about futures and options, okay? So if you are into the share market, most of you already know this, but what we will do is we'll try to understand the actual, theoretical part, or how is it actually going to work out, etc. is what I'm going to tell you. But this is from exam point of view. It may not help in your trading, okay? That I can take another session. What are the strategies which you can do for trading in futures and options? That I can take another session later. But now this is only from exam point of view, from covering the syllabus point of view only. I'm taking this particular session. So what do you mean by derivative trading? Whenever we talk about, there are two types of market that you know. First of all, there is a spot market, okay, and the transactions are happened on spot here. Then there is a forward market, okay. So basically our topic here is derivative trading, okay. This is there in your syllabus. So we have spot market and forward market. So transactions in forward market, here the transaction happened here is what we call as derivative trading, okay. So this is what derivative trading, or the transactions at the forward market is the derivative trading. Now what are the various types of transaction here? If you see different types of transaction, you have forwards, then you have futures, and then you have options, okay. Now options, within options there are two types: call option, that means right to buy, or option to buy. Different languages you will see in from different teachers, from different textbooks. It's actually giving you a right to buy after a particular date. Then similarly a call option, and also you have put option. Put option means a right to sell or option to sell. So a right to buy or option to buy, and right to sell or option to sell, okay. So this is what we are going to discuss today here. Spot market, already we have done the discussion, so let's get started with this. So spot market, you already know, we have already discussed, so I am not getting into that. So transactions are made at the prevailing price. Transactions are made at the prevailing price, and the transactions are usually completed on the spot. You're buying a share, okay, it's actually completed on the spot, and that is at the prevailing price. So here we are actually going to talk about forward market, okay. So in forward market, the transactions which are happening is what we call as derivative trading, and the types of derivative trading: forwards, futures, options, out of which two important ones are futures and options, because these are exchange traded. This forwards, when we talk about, these are bilateral between people, like a food manufacturer and a farmer, like that. These are bilateral trading, and there is no security or safety in that. So there can be no breakage of promises which can happen in between. It all depends on the individual and trust. So we are not talking too much about forwards, rather we discuss on futures and options more. These are regulated by SEBI. Before, different regulator was there, but now it is regulated by SEBI, and you can trade in futures and options in stock exchange. You can do that in NSE, BSE, as usual, what you do in case of other shares also, okay. So this is what we are actually going to focus more on, but I'll tell you what is forwards also. For example, if you see, okay, let's write the definition of forward market. Forward market. In this market, contracts are made to buy or sell something at a predetermined rate. That means price and date in future. So if you look from a farmer point of view, he promised to sell some product, or let's say potato or tomato, to the potato chips manufacturing company, okay. So what is the advantage for farmer here? He can save from price fluctuations. At that time, if bumper production is there, the prices can come down so drastically. I have told you, agricultural products are inelastic. Even if there is a small change in variation in prices, the prices can come down drastically. Same is the case with the the other side also the prices can go up drastically. So it can actually save the fluctuation in prices. And you can see here, if the future price is almost fixed, if it is known, then there will be not much fluctuations in the current price also. So it is actually considered good, and it is actually promoted by SEBI also. Okay, so forward market is actually promoted by SEBI, because if you know the price levels in the future, then there won't be much fluctuations at the current point of time. That's the most important reason why forward markets are, even though it is speculation, it is a speculation. I'll tell you why it is a speculation, or why it is arbitrage, or why it is hedging. All these terms I can explain here in beautiful way. I will explain from exam point of view, I'll explain, but later I've told you, I've promised you, trading point of view also I can explain that. Okay, so here forward markets, I hope you understood this is normal only. So derivative trading or derivatives means these are contracts, transactions in the forward market. So derivative trading means, so you can just write one line, derivative trading, these are the contracts in the forward markets. Okay, so these are the contracts or transactions in the forward markets. So what are the different types? So when we discuss about types, the first one, forwards. So this is what we will discuss first. First we will discuss this forwards. So forwards, so it is a, let me write down the definition first and I'll explain. It is a bilateral contract, bilateral contract to buy or sell a commodity or security. It can be a commodity derivative, or commodity futures. It can be security futures, like it is based on equity, Reliance futures, Manappuram futures, Tata Steel futures. Okay, so different, that derives its value from the share. Okay, so derivatives means based on some asset you derive its value. So Reliance, based on the shares, the derivatives or the futures will derive its value. That's why it is known as derivatives. Okay, so derivatives derive its value from underlying assets. What do you mean by underlying assets? If I'm talking about Reliance future is a derivative. So from where Reliance future derive its value? It derive its value from the underlying equity or underlying share. Okay, so that is what is the underlying assets of the Reliance? That is a share. So futures or derivatives derive its value from the underlying asset. So when we talk about equity or when we talk about securities, that is the underlying asset. So when we talk about Reliance derivatives or the Reliance futures or Reliance options, these are derivatives and they derive its value from the underlying assets. Similarly, when we talk about currency futures, okay, currency derivatives, they derive its value from the currency. Commodity futures from the commodity. Okay, crude oil also, like that we can see all these derivatives. Why it is derivative? Because it derives its value from underlying assets. That asset can be a commodity, that asset can be a security also. That's what we have discussed here. Okay, to buy or sell a commodity at a predetermined rate and date in future. See here, what all things you need to understand here is it's a bilateral contract. It is between two people. Okay, to buy or sell. So one party will agree to buy in future, one party will agree to sell in future. It can be commodity, it can be security. Okay, so at a predetermined rate and date in future. So it is actually delivery based. Okay, there are two types, delivery based and cash settled. So here it is delivery based. So one more point, delivery based. So I give you an example here, a farmer, and we will talk about a processor, a potato manufacturing or potato chips manufacturing company. So a processor, so they will enter into a contract. Let's say the farmer will say that the contract will be like, I will give you 10,000 or 1,000 kilogram or 10,000 kilogram of potato at how much? Let's say 10 rupee per kilogram. Okay, so 10,000 kilogram of potato at 10 rupee per kilogram. So how much farmer is supposed to get? 1 lakh. Okay, so the processor is agreeing that he will pay 1 lakh rupee this amount and he will buy this. Okay, so processor will pay 1 lakh for the farmer. So this contract is ready now. Okay, now this may be for 3 months, or after during the time of cultivation. So this contract might have signed before 3 months or during the time of sowing, and then after cultivation this contract, the expiry will be over. Now imagine at that time, so in case of, so this is what forwards in general. So now here what will happen if, let's suppose this price from 10 to increase to, let's say, 12 rupee. Okay, so actually after the contract, during that time the price increased to 12 rupee. Now if the farmer sell to this processor, he will get only 1 lakh, he will get only 10 rupee. If you sell it in the market, you will get 12 rupee. Okay, so that is one scenario. Or the price has come down to, let's say, 8 rupee. So if the processor buy from this farmer, you have to pay 10 rupee, that is 1 lakh. But if you buy from the market, you need to pay 80,000 only. So in these two situations, there can be, a lapse in the promise or the break in the promise. See, in the first situation, farmer may not sell to the processor because, it is between individual, the farmer won't care that. Similarly, the processor also may not agree in this particular situation. If the price is coming down, the processor may not buy. If the price is going up, the farmer may not buy. So because these are bilateral, these are between individual, so you need to make it formal. So you will do through exchanges, okay, like exchange traded commodities. So that's what we are going to see in futures and options. That's why I've told you that is more important, and that is actually regulated by SEBI. So here there is no such regulation. It is between two individuals. No intermediaries, no regulators are there. Okay. So forwards means simple concept. Exactly the same will be the concept in future. The same will be the concept, but it will be regulated by SEBI, and it is exchange traded in case of futures. So let me write down the definition of futures. I will tell you the mechanism also. Futures, these are exchange traded, means standardized contracts to buy or sell. So here the farmer will sell and the processor will buy a commodity. So I'm going to talk about that example. So it is a commodity. It is talking about potato. I can talk about the share market like Reliance futures, etc. That is security. Okay. So security at a predetermined rate and date in future. Now let me tell you one thing. I've told you already, these derivatives or the futures derive its value from the underlying assets. That's why it is derivative. Derivative means deriving its value from underlying assets. In case of Reliance futures, it is from Reliance assets, right? Reliance is actually the underlying asset, so the share of Reliance is the underlying asset. So the futures will fluctuate on the basis of the share fluctuation. So let's say if the share is going like this, the futures will also, so this is a Reliance share. Okay, that is what actually normally happening in the market, which you used to trade. Okay, I hope most of you, or at least few of you, are doing the trading. If you are not doing it, you can do it. Okay, even with small amount you can try that. So next is, we are talking about futures. So futures of Reliance futures also will move like this, almost like this only. Why? Because now why there is a small variation? Why this price difference is there? The price difference is there because they use a complex formula in calculating the futures and all, and you don't want to know that. But the trend, it's like how the shares are moving, exactly in the same way the futures are also moving. Why? That is the reason you need to know. Why? It is actually deriving its value from the underlying asset. What is the underlying asset? The share is the underlying asset. Futures are the derivatives, derive its value from the underlying assets. Okay, so similarly currency futures, commodity futures, etc. Now, if you go with the same example here, so here A is a seller, so he will say that I will sell, okay, so here the farmer, okay, so farmer will say that I will sell 10,000 kilogram of potato, 10,000 kilogram of potato at 10 rupee per kg after 3 months, okay, so after 3 months, maximum is actually 3 months. Okay, and then that's 3 months. So here, let's say what happens is the price is coming down to, let's say, 7 rupee. The price has come down to 7 rupee. In this context, who will gain? The farmer will gain, because farmer is selling at 10 rupee after 3 months, but in the market the price is 7 rupee. So farmer will gain how much? 30,000 here, right? 3 per kg farmer is gaining. On the other hand, if this price is going up to, let's say, 12 rupee, in this context, who's gaining? The buyer, who promised to buy it at 10 rupee. He will gain because he will be gaining 20,000 in this context. Okay, so but you know, in case of futures, whether it is in exchange, if you are going for Reliance futures or anything, you don't want to pay completely in the beginning. You just need to pay some premium, and that premium will depends on demand, supply, fluctuation, risk associated with that commodity or security, etc. Different things are taken into consideration while fixing the margin, so that your stock brokers, the discount brokers or the brokers will fix that margin and will tell you, and based on that margin you can enter into the contract, so you cannot run away. Okay, that things will be managed properly. So that's why it is exchange traded contracts. So I hope this is done. Or in case of securities, you will be buying the futures in lots. Okay, so let's suppose you need to buy 100 shares. You need to buy it in lots. Normally you can buy 1 share, 2 share, etc. So here you need to buy in lots. So let's say the share price now is 300. Let's say it is 300. Or you enter into a contract. No, forget about now or anything. You enter into the contract that after 3 months I will be buying 100 or 1000 shares. Let's say 1000 shares at 300 rupee. Okay, so one person buying at 300 rupee, other person selling at 300 rupee. Now the normal situation, right? If this price is coming down to 270, if this price is coming down to 270, who will benefit? The seller will benefit, right? Seller will benefit 30 rupee per share. That means 100 or 1000 shares is there, so 30,000, right? So 3 lakh benefit will be there, right? 1000 shares are there, so 30 rupee profit for each share, so 30,000 benefit will be there. Similarly, if this price is going to, let's say, 350, then who will benefit? The buyer will benefit, because buyer is getting it at 300 rupee, but in the market it went to 350. So if you need to buy from the market, you need to pay 350, but from him you can get it at 300. So that difference, that is 50 rupee, the buyer will benefit. So 50,000 will be the, or 50 per share will be the benefit. And when you're buying in lots, 50,000 is the benefit, because he can buy at 300 and he can sell immediately in the market, and this will be automatically done by the discount brokers. It will be automatically happening in the exchange. Okay, so I hope you understood. So this is how the futures are working out. Now when we talk about this, it can be delivery based, it can be cash settled also. Mostly in case of farmer that I have said, it is mostly delivery based. Okay, but in case of exchange that we have discussed, this is cash settled, because it's all about speculation. If you have good knowledge about, you know, what is actually going to happen after 3 months, you can speculate and you can gain, right? So it's all about speculation. Now why SEBI is promoting speculation? The reason is, if you speculate and if you can predict the future, then there won't be much fluctuations in the current prices. So that is actually going to help, and that's why it is actually promoted. So you get idea about what should be the price in the future, and then the price in the present won't fluctuate. Okay, otherwise you will be concerned what will be the price in future. So you may think that it will increase drastically, so you may try to hoarding and speculation and all those things will come at this point of time, that will increase prices. So if speculation is allowed, or futures, the main idea is, you know, there won't be much fluctuation in the current prices. Okay, so it is delivery based and cash settled. I'm not saying what is it, cash settled. Cash settled means, just now I have told you, it is what actually happened in the stock exchange. It is a kind of betting only. It's all about speculation. Okay, so objectives of derivative trading, if you see, what are the objectives? This was actually asked in prelims before. So the objectives, first of all, speculation. I hope you understood this. Second, hedging. Okay, third one, arbitrage. So what are hedging, what are arbitrage, etc. we have already discussed. See, when we talk about the farmer's case, farmer is facing actually 2 types of risk. One is production risk, and then market risk. Okay, so we can say his market risk can be solved through the futures, not the production risk. So forwards can actually eliminate the market risk. So we can say, since it is eliminating that market risk, can we say farmer is hedging? So from the farmer's point of view, it is hedging, because he can hedge from the market risk. Okay, so he's actually reducing the market risk. So it is a hedging from farmer's point of view. Then what is arbitrage? Arbitrage means buying from a cheaper market and selling at a slightly higher market. For example, in the market maybe 7 rupees the price. Okay, so now 7 rupees the price, and you will buy and you may store it. Okay, so cold storage maybe it cost 1 rupee. Cold storage it may cost 1 rupee. So you know, when it cost 1 rupee, so what is the total cost? 8 rupee is the cost. But what is the agreement? Agreement is 10 rupee, right? So you are actually getting 2 rupee profit here. 2 rupee means 10,000 kilogram. So you will be getting 20,000. I hope you understood. If the current market value is 7 rupee, you get that and you store it. Okay, that's what you mean by arbitrage. No, buying this pen costs 50 rupee in Tamil Nadu and 60 rupee in Kerala. What I do, I buy it from Tamil Nadu and I sell it in Kerala. That's what you mean by arbitrage. Simple concept. Okay, so exactly the same here. You know, in after 3 months it will be 10 rupee, but now it is 7 rupee. So what you will do, you can buy this and you can store it and you can sell it. So that is arbitrage. Forget about potato. Potato is perishable item, but in general I am talking about. Even in case of commodities, you can say this gold currency, or you can say in case of securities also. Okay, it is an arbitrage. You're buying now and you're selling later. Simple concept. Okay, speculation, I hope you understood. So the objectives is speculation, hedging and arbitrage, and it is actually promoted by SEBI. I hope you understood the reason why it is promoted by SEBI. So I hope you understood this. Because of this only, it actually reduces the fluctuations in the spot market. Otherwise, you know, spot market will fluctuate like anything. It will go like this, immediately you see the demand, and it will come down when you see selling. Okay, then when you see people buying, it will go like this, and this kind of fluctuations you can see, and that is not expected, and that is not desirable. So it should be like somewhat like this, like this, like this. It should be like this. It should never go like this. This is too much fluctuation. Why this will happen? Because you are so much uncertain about what is going to happen. If you are certain about what is going to happen, this is the case. So this situation can be maintained if you are allowing the futures, and that's why futures are there. So futures, the most important function is it actually prevent the spot market fluctuations. Okay, in the spot market the fluctuations will be very, very less. The share prices won't go, let's suppose the share price is, let's say 100 rupee now. Okay, and you know what is actually going to happen after 3 months, because futures are there. So it won't go to, let's say 500 today, and it won't go to 10 rupee also. So this is huge fluctuations, right? This will not happen. That can be prevented. I've told you already, these transactions are done in commodity exchanges. What are they? One is multi commodity exchange, MCX. Okay, that's the largest. Then National Commodities and Derivatives Exchange, NCDEX, National Commodities and Derivatives Exchange. Then National Multi Commodity Exchange, that is National Multi Commodity Exchange, etc. Okay, so all these were actually established in 2003. Okay, so commodity exchanges facilitate forward trading in selected commodities. So these exchanges will promote forward trading in selected commodities, like selected agriculture commodities. I've told you gold, okay, silver, petroleum products, etc. Then who's the regulator? Who's the current regulator? Current regulator is actually SEBI, like in case of stock exchange. So SEBI, earlier it was Forward Market Commission, and in 2015 actually FMC was merged to SEBI. So FMC merged to SEBI in 2015. Now let's discuss about options. Options are very important because this is like more hedging is possible here. You can actually reduce the risk to a maximum extent with options. I'll tell you here what is options, and after this you can even trade in options also. You will understand everything. First, understand the theoretical part. These are standardized or exchange traded contracts under which an investor purchases an option to buy or sell a commodity or security at a predetermined rate and date in future against payment of option premium. Okay, so here you are making an option premium, and when you are paying this option premium, you are getting a right. Okay, right to buy or right to sell, or option to buy, option to sell. So here you can see standardized. Okay, similar, that is actually happening at the exchange contracts, which under which an investor purchase an option. So here you are buying an option to buy or sell. So you are getting a right to buy or right to sell. So you are buying an option means you are buying an option that it can be two. It can be right to buy, it can be right to sell also. So you are buying an option. Option is different thing. So you are buying an option, and for that you need to pay a premium, and that can be right to buy or right to sell. You can sell or you can buy. Okay, so right to buy and right to sell, or option to buy. You can simply say option to buy or option to sell. Option to buy or option to sell. So a commodity, it can be a commodity, it can be a security. So at a predetermined rate and date. Now see here, what do you mean by right to buy and right to sell, or option to buy or option to sell? If you want, then only you need to sell or buy. If you don't want, you will just lose the premium. That's it. If you want, you can lapse it here, but that was not possible in case of futures. It will automatically have to get settled. Okay, but here after the expiry, if you want, you can buy. If you want, you can sell. There is no compulsion. That is what you are taking, that option premium. That is why you are paying that option premium, to get that choice. And here it is more safe compared to the futures. Only if you want, you can buy. Okay, see, for example, if the prices are coming down, then you can buy, because you can buy that and you can sell in the spot market, you get the profit. If the prices are going up, you don't want to buy, you can lapse it. What you will lose? You will lose the premium. That's it. Similarly, if you went for a selling, if you got the right to sell, if the price is going down, you don't want to sell. Why you are selling? If the price is going up, you can sell. Okay, so I hope you understood here. Now right to buy is what you call as call option. Call option. Right to sell is your put option. Okay, so in call option, what you are saying is you are buying a right. In put option also you are buying a right, but here you are buying a right to buy. Here you are buying a right to sell. You are buying means you are paying a premium and you are getting an option to buy or sell. So here option to buy, option to sell. Okay, you can see here, let's suppose 300 is a share price. Let's say TCS. Okay, option. Now 300 is a share price and 100 share you need to buy, because you can't buy one single share, you have to buy in lots. So how much it cost? Now whatever cost it's okay, you are not paying that cost immediately, because you are paying a premium. For example, per share premium is 25 rupee. Okay, so how many shares are there? 100 shares are there. So let's say premium is 25. So how much premium you are paying? 2500 premium is you are paying. Okay, now imagine the situation. So you have a right to buy. Here this is right to buy and you are getting a call option. So you have a right to buy, call option, or option to buy at 300 rupee. Now after 3 months, let's suppose market price is 400 rupee. Okay, market price is 400. That means if you try to buy from the market, how much it cost? It will cost 400 per share. But what is the right you have? You have the right to buy at 300. So you will buy or not? You will buy this. You will buy at 300 and you can sell at 400, and the difference is your profit, right? So here what is your profit? 100 rupee per share is your profit. So you will get this 100, and similarly 100 shares are there. So 10,000 profit you will get. 10,000 minus the premium you paid, 2,500. This is your actual profit. Okay, so 7,500 is your actual profit, because premium paid is anyway paid. Whether you have loss or profit, it doesn't matter. And here in this case, loss will not be there. The reason is, let's suppose the price is going down. Let's say the price is going down to 350. No, you have agreed at 300, no? So the price is going down to, let's say, 250. Price is going down to 250. Now in the market, how much cost? 250. But you are saying that you are ready to buy at, you have the right to buy at 300. Do you want to buy at 300 or you wish to buy at 250? In the market 250, but you have the right to buy at 300. It is a right, it is an option to buy. And for getting in that option, you have paid a premium. Before it was compulsion, now it is an option. Okay, before it was compulsion, you have to buy because you have entered into contract, but here you paid for that option. So here you won't buy. If you buy here, you can see 50 rupee per share is the loss. So you don't want to buy because you have already paid the premium, so you will lapse this. In this situation, you will lapse it. When you lapse it, what you will lose? The commission, the premium that you have paid, this 2,500, you will lose. So your maximum loss will be what? Your maximum loss will be the premium paid. What is your maximum profit? The maximum profit is unlimited. The price of the share, how much it is going, it depends on that case. But the person who is giving the option, his loss is unlimited. His profit is to the extent of the premium that he is going to get. In this case, he is getting the premium only. That is his profit. His profit is limited, only the premium. Okay, but see, only the smart people, those people who know everything. For example, if you take insurance companies, they take a premium, and do you think everybody will get accidents or everybody will get disease and everybody will be hospitalized? They are anyway making profit. Exactly the same principle is what working here also. Like what insurance companies do, they collect premium, and some cases it will be lapse, right? Most of the cases it will be lapse, so they get the premium. Exactly the same here also. They do the proper calculation, and after that only they fix the premium and they enter into the contract. They know that these are very technical people. They know everything about the market. They have done this studies and everything, but it's ultimately a zero-sum game. Okay, but the principle used is actually what exactly the insurance companies use. So they get the premium, and they get the premium from so many people. So if some people are making the profit, it's okay for them. Ultimately they will get the profit. That is the idea. Okay, so to enter into, see, you can buy options. You can buy options means it can be call option or put option, but if you're selling option, you need to be a next level, because you should have complete knowledge about the market. You need to know what is actually going to happen, because your profit is only the premium and your loss is unlimited. But when you're buying the option, your profit is unlimited but your loss is minimum. So it is easy for you also to purchase an option for 3 months, and you can pay a premium, you can purchase an option, and in case if it is good, if it is call option, if the prices are going, that means call option means what? Your view about market is a bullish market. Put option, you are expecting that the price will come down. That is bearish view. So people who hold the bearish view will go for put option. People will hold the bullish view, go for the call option. So I hope this is clear. Okay, I'll give you one more example. A and B. So A will say, if I want, I am getting the right, I am getting the option. If I want, I will sell 100 gram of gold at, let's say, 3,000 per gram after 1 month. I'll tell you the duration. The maximum duration is 3 months, but 1 month contract, 2 month contract, 3 month contract, both are there. Different terminologies are there in stock exchange. I'll tell you that. So 3,000 per gram. Okay, now imagine this price has come down to 2,700. Okay, this price has come down to 2,700. Now you will tell me who will gain here. A and B are entering into this contract, no? So A paid a premium to B. A paid a premium to B. Let's say premium paid is maybe 2,500. Let's take some numbers. So the price has now come down to 2,700. 2,700. So what will happen? 100 gram, 2,700. So you will make a profit, right? Because here you are selling. Selling means it's a put option. This is a case of put option. You will sell. You have the right to sell. You have the option to sell. So when the price come down, you will benefit. When you are going for put option, when your view about market is bearish, and that has actually happened. The price has come down. So you promised that you will sell at 3,000, but it has come down. So you will get the benefit, right? So you will sell at 3,000. You will exercise your right now. In the market it is 2,700 only, but you have the right to sell at 3,000. See, in the market it is 2,700, but you got a right to sell at 3,000. So market is 2,700, you are selling at 3,000. So you are making a profit of 3,000, and 100 gram is there. So, no, you are making a profit of 300. 100 gram is there, so you are making a profit of 30,000, right? So 30,000, and you need to subtract that commission or the premium that you have paid, 2,500. Then this is your profit. 27,500 is your ultimate profit. Okay, on the other hand, if it is 3,500, then what will happen? Will you sell at 3,500? You have the right to sell at 3,000. Okay, so in the market the price is 3,500, but you are having option to sell at 3,000. When the market 3,500, why you should sell at 3,000? So what you do, you prefer to lapse it. So when you lapse it, what is the maximum that loss that you can have? The premium that you have paid, 2,500. Okay, and this is the profit of the other person. So the other person will get this profit only, but you can get unlimited profit. So what I'm saying is, your loss is to the extent of the premium that you're paying, but your profit is unlimited. And on the other side, the other person, the loss is unlimited, but the profit is limited premium. But why he is entering into this, I've told you the concept of insurance company, exactly the same. Okay, so they have done the proper analysis, and after that only you can be an option seller. Option seller is known as the writer. So if you need to be a writer, you need to have that good knowledge. Okay, because your return is minimum, but your loss will be unlimited. Okay, so I've told you option to sell is put option. So this is put option, and this one I've shown you, this is call option, option to buy. So I hope this is clear for you. Now see, options can be traded for maximum of 3 months. So first month also maximum 3 months, 1 month is called as near month. Okay, so second month, this is the next month, or the mid month. When you are trading in stock exchange, when you are trading in with the stock brokers, you will see these options. To buy options, you will see these options: mid month, 1 month, or 2 month, or 3 month. What about third month? Third month is actually far month, and the options will be closed on the last Thursday of the end of the month. Okay, last Thursday the deal will be closed. So last Thursday, if it is a holiday, previous day. Okay, now what are the types of option? If you look into this table quickly, type of options, let's say option buyer, option seller. Option seller means I've told you already, the writer. So if you need to be an option seller, it is very difficult task. Option buyer, you can go and buy option. That can be two types: call option and put option. You can be a buyer of call option, you can be a buyer of put option also. If you are buying the option for that is call option. Okay, if you are buying a call option, you have the right to buy. If you are buying a put option, you are getting the right to sell, or option to sell. I hope this is clear. Slightly confusing and nightmare for most of the students. Even CA students also facing a lot of difficulty. Forget about civil service aspirants. Okay, even I am expecting that after this you can try trading also. You can trade in options. Very risky, because derivative trading is anyway risky. It's all about speculation. The big players are there to speculate, but still, if you have some good mathematical knowledge and economy knowledge, you can speculate. Okay, and you can make unlimited profit also. Okay, so here two types, call and put. So let's see the market outlook also. Market outlook of option buyer and market outlook of option seller also. So option buyer, what will be the market outlook for him if he is going for a call option? Bullish market, right? So bullish market. So he is having a right to buy, or option to buy. What about option seller in this case? That is obligation to sell. See, once you have the right, other person have the obligation. Okay, so he have obligation to sell. So his market outlook is actually bearish, right? That's why he is entering into the contract. Similarly, if you look into this case, put option, what is the market outlook? I have the option to sell, or the right to sell. Okay, so right to sell, that means I am expecting the prices will go down. So that is bearish market. Bearish. Okay, so right to sell, option to sell. So what about this person's option seller's perspective? Obligation to buy. When you have the right to sell, the other person have the obligation to buy. So what is his view of the market? His view is actually bullish. So I hope you understood this very technical topic, and we have done it in the best possible way. Then swap means it is similar to this. Okay, swaps. One more instrument is there, swaps. Let me quickly discuss about that also. Let me write. It is between two shares like TCS and HAL, okay, or TCS and Wipro, or Reliance and Tata, like that, exchanges. And the difference in shares of the prices is actually the profit and loss. So swaps, these are standardized contracts to exchange a commodity or security with another at a predetermined rate and date in future. Okay, so these are again happened in the exchange. It can be commodity, it can be security, with exchange with another at a predetermined rate and date. Okay, so here two variables are involved. Okay, what are the two variables? In futures, I will buy at this rate. Okay, so in futures, when we discussed, I will buy at this rate the share of TCS. Only one share is what I'm talking about, but here it is exchange between, let's say, TCS and Reliance, or TCS and Wipro, like that. So this is an exchange here. Earlier I will buy at this rate this share. So here we will exchange these two shares. So the profit and loss, actually gain or loss, depends on what? The prices of these shares. So it depends on the prices of these shares. Okay, now in futures, I've told you, you have to pay some margin. This margin or the premium, in case of options, the premium is actually fixed on the basis of what? This was actually asked as a prelims question before. Premium is based on demand supply, the equilibrium concept that we have already discussed in the chapter of demand supply. So firstly, demand of the option, demand of the shares and supply of the shares. Then spot price, what is the current price? Because based on that only you are expecting the future price. So spot price, time remaining. If it is 3 months, more premium. If it is 2 months, compared to the 3, it is less, and 1 month it is very less, because the risk and the volatility will be, somewhat predictability is there. No, the time period is less, more predictability. If it is more, less predictability. So time remaining is also important, and more importantly, volatility of the market. Okay, volatility of the market. Now when I'm recording this video that I'm doing in April, okay, so much volatile, the market is going here and there, okay, because of corona, complete lockdown. So it will be, the premium will be high at this point of time. But if you take intelligent decision, you will definitely make unlimited profit, but play very carefully. Next session I'll talk about the strategies in which you can trade in futures and options. Okay, so see you guys. Thank you.